Good afternoon, everyone. On behalf
Afternoon.
of
Good afternoon.
Good afternoon. On behalf of CII Southern Gujarat, it gives me great pleasure to welcome all of you to the second session of CII Virtual IPO Knowledge Series 2026. Thank you for joining us once again. We are delighted to see the enthusiastic participation from various people, entrepreneurs, promoters, MSME business leaders, and professionals who are committed to understanding the opportunities available through the capital market. During our inaugural session, we explored the strategic question, why IPO, and discuss how assessing the capital markets can become transformative milestone in company's growth journey. In today's session, today's session takes that discussion a step further by focusing on the routes and execution, that is navigating the basic pathway to capital markets. The objective is to help business understand the practical roadmap towards an IPO, including the difference between the SME and Mainboard platforms, the overall execution process, key stakeholders involved, indicative timelines, and the important considerations promoters should evaluate before embarking on the listing journey. Understanding the right route and the execution strategy is very critical for every growing enterprise. A well-planned IPO is not merely a fundraising exercise, but it's a strategic transformation that strengthens the government, enhances credibility, and creates a long-term value for all the stakeholders, including the investors, merchant bankers, etc. We are privileged to continue this knowledge session with our esteemed knowledge partners from Span Consultech. So we warmly welcome Ms. Sujata Desai, Director and CEO, Span Divergent Limited and Span Consultant, Mr. Paras Desai, Director and CFO, Span Divergent Limited and Span Consultech. Welcome, both of you. Their extensive experience in IPO advisory, corporate finance, strategic planning, and capital market transactions will provide valuable and practical insights for businesses aspiring to access public markets. We sincerely thank both our distinguished speakers for their continued support and for sharing their expertise with the CI community. I also encourage all the participants to please actively engage in today's discussion and make the most of this interactive learning opportunity made available to us through CII. With these words, I once again extend warm welcome to everyone. It is now my pleasure to invite Ms. Sujata Desai to begin today's session and share her perspective on navigating the pathway to capital market. Over to you, ma'am.
Thank you, Janak Bhai. Good afternoon, everyone. Welcome back to our IPO Knowledge Series in partnership with CII. It is wonderful to see you returning for episode 2 and a warm welcome to those joining us for the first time. I am Sujata, CEO and Director at Span Consultech, which is advisory venture of Span Divergent Limited, which is formerly Span Diagnostics Limited, which is one of the early companies of Surat listed on stock exchange. Span Consultech help promoter-led businesses realize their full worth. We provide services on business diagnostics, strategic consulting, IPO advisory, turnaround advisory, and CXO services. In our first episode, we explored a fundamental question, why IPO? We discussed that IPO is one of the fantastic routes which supports companies with clear vision to grow. So IPO is opening doors for free source of funds, access to much larger pools of investors. It improves visibility to multifold, can be one of the tool for talent attraction, opportunity for exit to early investors. We also learned that going public is not just a financial event, but it's a transformation. It changes how your company is governed, how it is perceived, and how it grows. It never restricts your entrepreneurial decision making or restrict your dreams. It just makes your efforts and style more structured and organized. Many of you left the session with a clear sense of applicability, appropriateness, and potential of going public, considering an IPO for company's future. Today, we move to the next natural questions. If you decide to go public, how do you get there? Common understanding is IPO means I file with SEBI, I list on the exchange, and we are done. But it's a bit more than that. And at the same time, it does not have to be that complicated either if you know your options. India's capital markets offer you more than one door into public listing. And the door you choose determines your timeline, your compliance burden, your investor base, and even the way the market reads your company on day one of your listing. So all these routes, every single one, operate within one comprehensive rulebook of SEBI, which is SEBI ICDR regulation. Today's session will dwell upon the various routes options, its applicability, and clear idea as which route is appropriate for your business. So as we go into today's session, I want you to hold one question in your mind. Not just, can my company go public, but which route is right for my company at this stage with this profile and why? That is the question our speaker will help you answer today. I hand over the session to Mr. Paras Desai. Thank you so much.
Thank you, Sujat.
Paras bhai, you'll have to unmute. Paras bhai, unmute yourself. I think we are not able to hear you.
Can you see the slides?
Yes, yes, and we are able to hear you also.
Thank you. So, good afternoon all, and welcome to session 2 of episode 2 of our IPO webinar series. Today, it is a special day to be hosting this episode. The reason being, the first monsoon showers have just arrived in Surat. There is a sense of transition in the air which feels appropriate given that we are focusing on the most transformative transition a company can undergo, and that is the IPO process. So there cannot be a more appropriate day than today, where the rainy season is starting, and also we are embarking upon a very transformative milestone in our business journey. Now, before we get into IPO routes and regulation, let me start with a small experience, and this time not with an entrepreneur, but with my own wife. It so happened that me and my wife were going at a place. My wife opened Google Maps, entered the destination, and it immediately gave 3 routes. Generally, as Google Maps give, the fastest route, the shortest distance, and with the fewer tolls. And then there is usually a one confident person in the car who says, forget Google Map, I know the proper way. And incidentally, that day, that person was nobody else but myself. So I tell, I will navigate you. And then eventually turn out that proper way confidently suggested by me was everything except the proper way. It was characterized by a narrow, uneven road, traffic, a wedding procession, one cow sitting in the road, in middle of the road, claiming the ownership of the road. And finally, Google start telling rerouting. And to my dismay, there was a tense silence in the car, and the stern look just besides me stayed with me for a long time, even after the journey. So that day, I learned a very hard lesson that the destination did not change, but the route changed the quality of the journey. So when you are eyeing a destination, you must carefully choose your road with the help of a reliable navigator. So that is I learned the hard way few months back, and that is what I am trying to transform here in context of this IPO routes and execution. In the last IPO, we discussed the larger question, why should a company consider public market at all? Of course, we discuss about growth, strategy, and all this. Today, we move from why to how. Once that decision is made, once we are clear that for my objective or my business, IPO is the proper way. So now this episode will be focusing on how. So let us first see the broad map of what this episode will cover. This episode is designed as a practical execution map. We will begin with the first work, SME platform versus Mainboard. Then we will look at eligibility, offer structure, cap table readiness, pricing, anchors, book building, bankers, timeline, and the cost of IPO. The purpose of this episode is to help promoters and leadership teams understand the process. The reason, because if they understand the process, they know right questions to be asked when they really enter the process. So this is what the objective of this episode. So the first big question comes to us, which is deceptively simple, that which listing route fits the company, the SME IPO or the main IPO. Now, before we compare between the SME IPO and the Mainboard IPO, I hope that you all know what is SME and what is Mainboard. There is a kind of ecosystem in our country that the company, keeping in focus the small and medium-sized enterprise, there are a dedicated board like NSE Emerge and BSC SME, whereby they encourage a growing company, the profitable company, growth stage companies that are profitable and ready for public market decision, but they may not have a scale for institutional depth or the bigger governance structure. So keeping those kind of company in mind, they have created a tools platform, which is, we call it SME platforms, that is for small and medium enterprise. NSE operates Emerge platform and BSC operates SME platform. So this, and another platform we all know is a Mainboard, which is for the larger companies seeking for the larger capital who are matured enough and who are looking at the larger pool of the investors. For them, the Mainboard is the platform. So you can see kind of magnitude with which both the platform operates. For SME, in order to be qualified, your capital, paid up capital cannot exceed 25 crore. You need to remain, your paid up capital must remain within 25 crore, then you will be eligible for the SME Mainboard. On the other side, if your paid up capital is 10 crore or more than 10 crore, then only you will be eligible as a first entry filter for the Mainboard. So these are the two platforms which are available to the company which is looking for an IPO. So the right question is not which route is easier. The right question is which route honestly matches company's size, its readiness, investor base, and the future ambition of the growth plan. So if we have a little fair idea, okay, my company can opt for the SME IPO or the Mainboard IPO, depending upon the fundamental criteria, we can further look into it, what other factor that we need to see before while deciding the proper route. So for SME listing, if you can see on the slide, NSE Emerge and BSE SME are broadly similar platform, but they differ in certain parameters. For example, the net worth requirement for an NSE has to be positive, while for BSE, you need to have 1 crore or more net worth in minimum 2 years of last 3 years. Net tangible assets would be more than 3 crore for BSE. So far cash flow is concerned, you must have positive free cash flow to equity in order to be qualified for NSE. Now, what I mean by free cash flow to equity means your cash flow from operation plus debt. So these are the criteria. And for BSE, your debt to equity, that is the leverage ratio, should not be more than 3:1. So these differences matters at the time of route selection for if you're looking for the SME listing. So far Mainboard is concerned, they have got two big fork. One is under regulation 6.1, which will come in detail in the subsequent slide, and another is regulation 6.2. In short, Regulation 6(1) is for those company who has got a very financial good track record. They have got a financial criteria, who has a profitability track record, who has net worth is good, who has capital structure is proper. So those are the criteria which is laid down under Route 6(1). Under Regulation 6(2), it is not based on the financial capability or the criteria, but it is based on the qualification or the uh, relaxation or the kind of institutional investor confidence in you, and that is why it is called the institutional route. So route Regulation 6(2) is not the relaxation in the commercial sense. It is a different gate. The market must receive institutional validation through QIB allocation, that is qualified institutional buyer. So as mentioned in episode 1, the capital raised, it is very important to inform that where you are going to apply or where you are going to deploy that capital. So in both the routes, it is very strictly defined in order to be qualified the application of the capital. And that is why they have restricted that only up to 25% of the capital can be used for the general corporate purpose. Many companies, they don't specify, just mention the general corporate purpose, which give them some kind of freedom to deploy anywhere they wish. So that is restricted. And these also include any unidentified acquisition target that you may specify. It is covered under this 25% cap so far the SME IPO is concerned. So after eligibility, the route also changes the issue structure and post-listing obligation. So it's not just the eligibility criteria, it is much more than that. So this slide demonstrates the route comparison by looking beyond entry criteria. If you look at SME route, it comes with specific discipline. The important amongst them is underwriting. Any SME IPO has to be 100% underwritten. That means it must be guaranteed that it is fully subscribed. Then there is a requirement for market making. As the SME size is less, it is LOTs are maximum 200, minimum 200. So it is kind of a focus. So in order to ensure that it doesn't remain illiquid, liquidity is ensured, transaction takes place in the market. So there is an inbuilt mechanism which is called market making, wherein at least 5% of the raised equity has to be traded by the market maker. So they would offer both buy as well as sell option on the exchange. So this ensure that the equity share remains liquid and it's not get cornered or it doesn't become non-traded. Then there is a minimum LOT spread to ensure wide investor base. Lot size logic, the lot size is minimum 1 lakh and investor has to have minimum 2 lots. So this is also to attract HNI and more serious investor to subscribe for the SME. The Mainboard route gives company-wide visibility and deeper investor access, but it also brings SEBI review, quarterly reporting, governance expectation, and broader public shareholder base. SME is a bit relaxed as compared to Mainboard, but Mainboard it comes along with its lots of compliances and governance expectation. So once again, the decision is not based on how much money I can raise through an appropriate route. It also, while making that decision, you must also consider what ongoing discipline am I prepared to accept after listing. So these are the criteria, eligibility criteria, entry gate, and subsequent post-listing, the compliance structure that one should keep in mind while deciding the route for the IPO. Now let us zoom into the main board eligibility, which is for many of you is main subject of interest. So for main board, there are two routes. The First route is under Regulation 6(1), which is also called the financial track record routes. This is suitable for established profitable companies where the past performance itself supports the investor confidence. You can see, in order to be eligible for the main board, your net worth should be greater than or equal to 1 crore in each of the last 3 years. Your net tangible assets should be more than 3 crore, out of which not more than 50% should be in form of cash or liquid. And if it is there, you must give a very firm undertaking that those assets will be utilized for the business for which the IPO is being issued. Average pre-tax operating profit should be 15 crore in last 3 years. And so these are the criteria for the route 1, that is the profitable financial profitable track record route. Now, suppose if you do not have a financial track record, if you cannot meet this financial criteria, you have also have another option, which is under Regulation 6(2), or which is also called institutional route. It is used where the company may not satisfy the profitable track record. The practical implication is very different. Under Regulation 6(1), the company demonstrates operating history, but under Regulation 6(2), the company must convince the institutional market more strongly. The Route 6(2) are generally selected by the startups with exciting equity story, capability to disrupt the market either through technology or unique business model. And it is a kind of regulator saying that if you do not have financial track record, go convince institutional buyer, sell your growth story and bring the money, because they don't want to expose the retail investor with a kind of risk which comes along with the Regulation 6(2). So now let's see each route, how the investment profile is. As you can see, the route selection changes the investor mix. Under the profitable route, Regulation 6(1), the QIB, that is the qualified institutional buyer, can subscribe up to maximum 50% of the total IPO value of the net offer. Remaining minimum 35% has to be by retail investor and 15% minimum has to be by non-institutional investor. While under Regulation 6(2), the issue become institutional led, where minimum 75% of the issue has to be subscribed by the QIB or the institutional buyer. So this is the kind of structure. This is how the investor profile are under both the route. The 6(1) route put more stress or give more emphasis on the retail investor, while 6(2) gives more emphasis or the more allocation towards the institutional buyer. Now let us look at a very interesting case study whereby a company with no financial track record, based on his equity story and growth story, become a very successful equity IPO in the history of country. I am talking about Zomato. You know all Zomato, it's a very popular brand. So Zomato was not sold to the market as a conventional profitable company. It was sold as a consumer internet platform sitting on a large behavioral shift. The behavioral shift was the way Indians were consuming food. So from Indians eating food out, the behavior was shifting towards ordering in, discovering restaurant online, and gradually moving from offline food decision to an app-led food decision. The equity story was not that here, this is our track record. The equity story was we are building the food service model in India, which has never been built. The company's proof was not just revenue, It showed scale, users, restaurant listing, city presence, app usage, delivery network, brand recall, and the possibility of long-term operating leverage. Investors were being asked to believe that once scale is built, monetization will be a natural consequences. This is exactly where regulation seeks to become relevant. The regulator says if retail investors are being offered shares in company where the conventional profit test is not satisfied, then institution must first validate the story. That is why QIB person become very dominant. So under Route 6.2, don't misunderstand it that if I don't have a profitability track record, I have another opportunity to go to Route 6.2. That is not the case. Here, Route 6.2, you are not selling dreams, you are selling a future. But that future must be supported by measurable operating evidence. You cannot just say loss-making route. You must say it is institutional validation route. And when institutions validate, they become more stringent, more watchful, and more knowledgeable about your business as compared to the retail investors. So after having understood the anatomy or the detail about the routes that is available for any prospective IPO bound business, let's try to touch upon a kind of a pre-IPO validation tool that that is many times successfully utilized. What I'm talking about is pre-IPO placement. A pre-IPO placement can be very powerful when it is structured correctly. This is underlined. No, it's not just that pre-IPO placement is always useful. The underline is that when it is structured correctly, it brings the independent price discovery point before the public issue. It can put credible investors on the cap table. It can reduce the size of the fresh issue and improve comfort around valuation. Now, imagine any investor which is coming to your business and making investment, putting his money. He will not just put it blindly. He will check your business model. He will check your growth story. He will check your past performance. He will do the valuation. He will try to correlate your past performance with your growth story. And then a valuation will emerge, and at that valuation, he will invest in your business. So how this will be perceived by the outside other larger investors? If the investor is reputed, they will have more confidence. Okay, if that person has invested, there must be something he must have seen in the business. So your business credibility improves. They also understand before making investment by any private equity or in a pre-IPO placement, there will be a deeper due diligence and total checking of the business. So it increases the confidence about your governance model. So this investor quality, valuation basis, objects of issue, and disclosure treatment all need get aligned, and you have a better chance to become successful when you go for the listing. So if this is structured well and executed well, for a promoter, this is like getting a serious co-traveler in a car before long journey of IPO begins. The investor will help you to make your IPO successful. So let's move next to the structure of IPO itself. Who receives the money? What is generally where the money of IPO goes? So every IPO has one basic structural question. One is the money going to the company, or it is going to existing shareholder, or both? If in a fresh issue, the company raises new capital, the market usually reads this is very positively when the object of the issue is linked with the growth. Because of the company growth, business growth, its valuation increases, market capitalization increases, the investment value increases. So any process going into the business growth plan is perceived very positively. It could be even debt reduction, or it could be a working capital requirement for giving impetus to your business. Other way, which is also called, you must have heard the terminology OFS, or offer for sale. Here what happens, existing shareholders sell part of their holding, and this is not wrong. The promoters or the investor which has put their money a few years back, they would like to unlock their valuation. So it's a liquidity event for few of the investor, and market understand that is not wrong. OFS is not wrong, but the market will certainly ask the question, why they are selling, how much they are selling, and what confidence does the continuing group retain. So they try to weigh how much is OFS, how much is money which is coming to the business, whether the promoters are still holding substantial portion, how much portion of the money they are unlocking or they are offering to the issue, and this entire structure they will see and then evaluate the quality of your IPO. The same rupee size can tell different story depending upon the mix between fresh issue and offer for sale. So once the mix is clear, how much to offers, 100% for the company, partly offer for sale, partly offer for the company. So once that mix is decided, then the next question is, what should be the appropriate size of your IPO? So let's dwell upon that. The common misconception is that I must raise the maximum amount if I am going for an IPO. The reason being, lots of 2 to 3 years of hard work, the expense in bringing in IPO, and so much of time and energy and money spent for this entire transaction. So, and it is once in a lifetime for the company which has come to this level even. So many things that I must get maximum, I must collect maximum capital through this event. But we have to take a pause before jumping to this conclusion. The better starting point for thinking the size of the IPO is, you must visualize or you must carefully design what should be the post-issue cap table look like, capital table. That means if you look at your balance sheet, who are your investor, what your equity should consist of. It also has to be evaluated from the lens of regulatory requirement. So how much promoter holding should remain? What public minimum float is required for your size for the company? How much dilution for the promoter is accepted or they are mentally prepared? What institutional ownership that you want to retain? So this is a total picture. Keeping all factor in mind, you must define your issue size, the volume of your IPO issue. So IPO size is therefore not only a funding number where you try to maximize this, it is an ownership design decision within regulatory framework, which is very important. So you have identified the route, you have identified the mix, you have kind of fair idea about the size of the IPO. So now probably you are inching towards the IPO issue process. But before doing that, one more important housekeeping which is needed to be done and which is very critical in entire process is that you have to structure your existing capital. Now let's come to the thing. Many growth company like you, many of yours, must have obtained investment or fund through different routes. Common among them are compulsory convertible preferential, we call it CCPS, convertible debenture, private equity financing. Each of such investment comes with their respective term sheets and the shareholder agreement with different conditions. So if you have one or two options available in order to raise capital in past, it must be reflecting in your capital table. SEBI and investor want to see ordinary equity very clearly without any strings attached. If there are convertible instrument, special rights, sometimes some condition through side letters on unresolved option pools, they must be cleaned up or resolved before IPO process advance. This includes investor veto rights, liquidation preference, or unusual shareholder arrangement. The SEBI basic principle is that SEBI want to see each and every equity holder on the same footing. Once your company become public, the market should not discover hidden economics sitting behind the ordinary share capital. SEBI wants each shareholder on equal footing. So this is it will reflect very bad post-listing if it is come to the surface that your cap table was not clean, there are lots of hidden string attached, and then it will reflect very poorly and affect your prices on the market. So a clean table is not just housekeeping, it is part of the investor protection. So once structure is ready, issue size is ready, mix is known, the next question, which is very, very critical and very important, is pricing of the IPO. Now, this is the point where emotions, ambition, and market discipline converge. How? Promoter wants the highest valuation. Investor wants margin for safety. They don't want to be at the peak of the valuation. The bankers want transaction that get subscribed and trades well after the listing. So there are the converging of interest. The price band should therefore be defensible. One should not be aiming that I would like to get maximum out of this opportunity. No, any price band that is proposed or being thought of must be defensible. Defensible meaning there that it should be justified by a comparable companies in the similar business, your past growth rate, your margin, your profitability, your historical returns on your capital employed, your discount free cash flow projections based on or supported by the past trend, the sector sentiment, that means whatever sector you are in, how that sector attractiveness is being perceived by the investor, and more importantly, the market appetite to absorb that high value. So these are the factors you must consider while the pricing band is decided, and whatever is decided, it must be supported by all these factors I mentioned you. The price that looks attractive on the day of filing can become dangerous if market believes there is no upside left for the new investor. So aiming for the best price should not always be the ambition. Now this brings us to a simple but powerful lesson from the recent IPO cycle. When we are on the pricing, let's see what happens in as recent as 2025. Recent IPO cycle have shown one thing very clearly. When the issue is priced for perfection, that is the maximum value, the secondary market become unforgiving. And this is shown by 2025 issuers fell 15 to 35% on listing day itself. So a small discount to fair value is not charity to investors. It is a tool to build a stable shareholder base, support post-listing performance, and preserve credibility for future capital raise. It is sometimes felt that leaving something on the table or deciding price little less than the value that has been derived is money lost. But this is in the long term, long run, if you think it with taking the total picture is not the correct thing. In capital market, it can be actually be the cost of building trust, the trust of investor. A successful IPO should not be judged only by listing day price. You should not feel very happy. Oh, my listing is done even higher than my listing price. It should be judged by whether the company has created a durable relationship with the market. Day after day, even post-listing, you continue to trade higher than the issue price. That shows the investor confidence. That shows that investors are sticking with you, believing your growth story, and they would be there with you even in the case of volatility. So in this context, let us have a look at it another case study where what happens when an ambitious pricing was done. You must have heard about the company called Glotis. The company had a very good business story. It was a multimodal logistic company providing transportation solution through ocean, air and road logistics. It also had a fresh issue component for purchase of commercial vehicle and containers. So which could sit well with the growth link use of fund which has been put into their business plan. But the IPO did not receive very strong market enthusiasm. It was subscribed only 2.05 times. The QIP portion was only 1.87 times. Retail around 1.42 times. NII 2.97 times. So overall, the issue got completed, but only 2 times. It was subscribed. But the real message, the sentiment of investor in terms of pricing comes on the day of listing. Against the issue price of 129, the stock listed at rupees 84 on NSE at discount of 34.88%. The issue was in the price band of 120 and 129. The issue was price was put 129 to the highest band, but on the listing day, it listed at 34.88% lower. Same with the case with BSE, it listed 31.78% lower. So why this happened? So this was the market communication. The market was saying very clearly that the IPO price did not give enough comfort to the new investor. So this is the market way of telling by listing at the lower price. So why did this happen? What was the reason behind that? The first, the subscription was moderate. A 2 times book may technically complete IPO, but it does not necessarily create strong post-IPO listing demand. Institutional buyer QIB, they do not rush to subscribe. They may feel post-listing because the valuation is higher, it is overpriced. Let us wait till it got listed. Probably the price will go low. At that time, we will jump in and buy at the lower price. So the QIB showed less interest. The second, the issue had both fresh issue and offer for sale. Offer for sale is not wrong. And it is selling is okay, fine. But when existing shareholders are selling and new investors are entering at the full valuation, they ask very natural questions. Why should the new investor take the full risk at this price while existing investors are unlocking their value at this full valuation? And third, logistics is an execution-heavy business. Margins, customer concentration, working capital, hired asset, and freight cycle. There are all matters. It is kind of a risk profile. And one such risk as this, investor expects some cushion in the valuation because any of the factor can go wrong, which is beyond the control of the promoters of the business. So if such happens, they want valuation cushion. So learning from the Glotis is very sharp. A company may have a business, a sector story, and a growth plan, but if the market feels that the IPO price is too full, the listing itself becomes a negative signal. So this is the kind of, I wanted to drive home the real life scenario in context of the pricing. Now, how we can try to reinforce or establish a confidence about the pricing that we define. And the one where the market tests pricing confidence before issue opens is through a mechanism or the investor community called anchor investor. So let's see about anchor investor. We have reviewed in Mainboard routes about anchor category, investor category QIB, and within QIB, there are anchor investors. Anchor investor, part of the qualified institutional buyer who commit before the public issue opens. They commit to invest even the issue opens. Their participation tells market that sophisticated investors have reviewed the valuation and are willing to commit serious capital. Now, these anchor investors are not small investors. They are very reputed investors, sovereign funds or big mutual fund house. So when they come on the board and commit themselves even before the IPO books opens, it gives a very strong signal to the market that they have evaluated the price, they have shown the confidence, so it is have a very positive impact. The key point is that anchor sits within QIB. Under anchor framework, up to 60% of QIB portion may be available to anchor, and within that 40% has the reservation with anchor investor portion for specific domestic institution and other mutual funds. The anchor fund matters psychologically as well as financially. As I've just mentioned, a strong anchor book can improve confidence across the rest of the book, and a weak anchor book can raise questions about public bidding even before. So let us understand how anchor allocation works operationally one day before the issue opens. Just a little run through it, the process. Anchor bidding opens one working day before the public issue opens. This is why it is called T-1. T is the day issue opens. Unlike public QIB book, anchor allocation has a discretionary element. The issuer and book running lead manager can choose an appropriate anchor investor if they have provided the bid. And this is very important. If good name has put their bid for the investment, choosing them shows very strong message to the market. So this question is valuable because the anchor's list becomes a signal to the market. Now, another important thing is that there is also a price discipline mechanism. What is that? If the final issue price is higher than the anchor allocation price, if for example anchor has anchor was allocated 110 rupees and the issue price open after the closing of books is 115 rupees, then it is compulsory for anchor investor to pay additional 5 rupees if the opening price is more. So these once again reinforce the confidence in anchors that they are ready to pay even higher than what they have initially evaluated, and it is a very positive sign for the anchor investor. So once anchor investment T-1 day anchor investor investment book is over, then the real book building window opens. Now, what is book building? It is nothing but the mechanism through which demand is converted into the final issue price. The issuer announces a price band, which is in the band of 20%. Is the cap price cannot be more than 20% of the base price. So issuer announces band price band. Investor bid within that band. The electronic book records price and quantity. At the end of the window, demand is tagged and the final price is discovered. To give you an example, for example, IPO issue size is 10 lakh shares. Then the system counts all bids at 120 rupees. For example, it is 3 lakh share. So it is not sufficient to cover entire issue size. Step 2, system counts all bids at 115 rupees. It is 4 lakh. So 4 lakhs plus 3 lakhs, 7 lakhs. Still, it is running short of 10 lakh issue size. So they go to the third step. System counts all bids at 110 rupees. So, and they found that 50 lakhs shares have been bidding for 110 rupees. So the 5 lakhs, 4 lakhs and 3 lakhs, that means total 12 lakhs. So your target is crossed at 110 rupees. which is 10 lakh shares. So 110 rupees is your cutoff point or the issue price. So that is how the bidding process is done, and the prices are stacked and the cutoff price is defined. When the investor make application, the fund gets blocked through ASBA or UPI. So it is not given to the go out of their account. It is just block into their accounts. And if they get allocation, then only it is released. Otherwise, it comes back. So this is the kind of foolproof system where earlier the refund used to take lots of time to come. Now here money doesn't go. Money goes only out of account if you are getting allocation. So then the book building is done, book is closed. Then what happens? There is a process called T+3. Once the book is built and the issue closes, the IPO enters a very compressed and very fast execution window under T+3. The issue closing date is T. On T+1, that is the next day, the basis for allotment is finalized amongst all the investors. On T+2, refunds are given, unblocking, that is the allotted person's money is being taken and the demat credit is completed. And on the third day, the share is listed on the and trading starts. So this is counted in working days. So this is what the common T+3 mechanism. Now, we have seen the book building, we have seen the anchor investor importance of institutional buyer. So these all are very critical processes in order to make IPO very, very successful. And one of the important agency which drives this is your merchant banker, or also we call book running lead manager. So one has to be very, very careful while choosing an appropriate merchant banker. The main criteria for choosing is should not be the fee structure, but its capability, its track record, and how much successfully he has completed IPO in past. So that should be the main criteria and not the fee structure. Because in order to save few percentage of some money in fee, probably you will be losing crores and crores in terms of valuation or loss of valuation. So this is just, I wanted to put an emphasis while we are on this topic. Another important thing we always touch upon in all our episode, even we touched upon this in our last episode also, the execution, how you execute or how you prepare for the IPO process. An IPO involves several advisor teams working in parallel: merchant banker, legal counsel, auditors, register, advertiser, internal management, internal teams. Now, if the company does not manage this like a program, so many agencies, the process is definitely destined for the chaos. Queries get lost, version multiply, decisions are delayed, disclosure become inconsistent. So a strong IPO steering committee, clear internal orders, a properly controlled virtual data room, and a milestone tracker like a project management is must. The discipline shown during the IPO process gives investor a preview of discipline the company will carry even after listing, because this gives the perspective of what kind of company it is. So let's see what could be a tentative timeline. It takes anywhere between 9 to 24 months or even more, depending upon your current preparedness. A clean, well-governed issue with ready financials, clear structure may reach within 9 to 12 months. But a company needing group structuring, accounting cleanup, related party cleanup, governance issues may take 18 to 24 months or even more. This is why early ready map matters. Filing the DRHP is not the beginning of IPO preparation. It is the point at which a lot of preparations must have been completed. So we mentioned in our first episode, with respect to preparedness, the proceed, prepare or defer this mimic or this mirrors the same principle. You must proceed only if you are prepared, and you must defer if you are not prepared. So this is what is the timeline looks like. Now, the objective when you are going for IPO, the objective is not mainly the oversubscription. It must be the quality of investor that you are able to attract. It should not be hedge fund. It should not be arbitrage fund manager who objective is not to stay longer for you, but they just plan to liquidity. So your objective must be attract the investor, quality investor, which can be have a longer commitment. In order to do that thing, you should have very curated message to an investor education, which involves equity story, business KPI, projection of business KPI, past performance, scenario sensitivity, considering risk factor, transparently talking about the risk factor, meetings, research support. So anchor investor selections. So once we are in the once we decide and we are trying to woo all the investor, this constant process, the drilling process, meeting investor, telling them the investor story, backing them with the data, facts, being transparent, pay very long-term fruit. So the distinction is important. Marketing is strategic. Public allocation is mathematical and route-based, and investor selection is the most important thing. So once everything is laid down, we should also have a look at the cost of IPO when we embark upon this project. Going public has two kind of cost. One is the transaction cost, going public. It involves merchant bankers, lawyers, auditors, registrars, advertising, exchange fee, printing, marketing, and other expenses. The larger issue, in terms of percentage, the cost is less, maybe 3 to 4%. But the smaller issues for less than 10 or 100 crore, the cost may go up to 7 to 10%. So, and the other cost, I will not say it's a cost, but it is kind of a running a public listed company, is the cost of compliance, where as a listed company, there has to be a quarterly reporting, investor relationship, board and committee process, internal control, compliance, disclosure. So these all involve cost. It is not very gigantic cost, but then one has to bear in mind that these are the compliances and cost attached will come. So after having a complete picture, fair idea about the route and execution journey of IPO, let's close this discussion with a central message, which is, I would like to say, going back to where we started the road trip, once the destination is clear, the journey still depends on the route, timing, preparation, traffic condition, navigation, and discipline. Same is the case with IPO. The destination may be capital, the destination may be visibility, liquidity, or the growth. But the result depends upon the route selection for the IPO, issue structure, proper pricing, anchor investor strategy, banker selection, governance, and execution control. This all matters when you are undertaking or envisaging a successful journey towards your destination, which is your capital, visibility, liquidity, or growth. A great business can still have a poor IPO. Your business is great, it doesn't mean that your IPO, you are bound to successful IPO. Not mainly as a fundraise, but as a platform, the next stage of growth. So the message I would like to leave you with, which is very simple. Ambition creates destination. Yes, your growth ambition has created destination of IPO, but execution decides whether you reach there with confidence. This is what I wanted to emphasize at the end of with this, I end of my presentation. Thank you very much. And I'll be happy to take any questions. And we'll be meeting next week with very important constituents of our IPO journey, which is business diagnostics. Thank you very much.
Thank you, Parasbhai. I think it was little too technical, but okay. I think you covered very wide aspect of it. So thank you for the insightful and highly informative presentation. It talked about IPO execution journey, including the various listing routes, difference between the SME and the large or mainboard platforms, processes, timelines, and key consideration for all the stakeholders, including promoters, etc. I also would like to sincerely thank Sujata ma'am for setting the context for today's session and sharing her valuable perspective on how business can strategically prepare for a successful IPO journey. So along with the business, in case if somebody is contemplating, then these steps are very important and critical, like even Parasbhai explained. Now I leave floor open for question and answer. If any of the members have any queries or questions, kindly be vocal and ask your questions. Yeah, SK. I think there are some people have raised.
It's there.
Yeah, the one question. Yeah, please.
We start with SK.
Yeah, so we received questions. Can you please
Right investment.
how right investment banker to be chosen? Now, this is a very good and very pertinent questions. I can answer you right now, but we have a very, very detailed discussion in episode 4, where we have laid down a very detailed criteria as how each agency involved in IPO process to be chosen, what criteria to be considered, what are the filters, what are the do's and don'ts. So if you can wait till episode 4, you will have a very comprehensive and very detailed explanation about the selection criteria, rather than I just give you in one or two reply. But just as I mentioned during my presentation, the basic criteria is track record, is credibility in the market, rather than just the fee structure. The post-listing performance of IPO, the kind of relationship with the investor that he has, repo, his own ecosystem. So these are the few points that we must consider while we choose a merchant banker. But in great detail, we will come to this point when we have episode 4. Thank you.
Thank you, Parasbhai. Any other questions?
No, I think.
No more questions?
Hmm.
Okay, I have one question. There are a lot of companies where they get approached by the private equity, etc. So, do you feel that for a growing enterprise, that is the right approach to review that as a first phase? And whenever these people they ask for, exit 3 year, 5 year, at that time it's the right time to go for IPO?
Yeah, it's a very, very good question. Your involving private equity has to be not a kind of a one decision or the one point decision. It should be evaluated in your overall plan scheme of things. Suppose your business, you have a plan or you have a vision for 5 years, 6 years or down the line, and in order to fulfill that growth plan or that business vision, you are in need of capital, whereby which can be considered by an IPO route, because other alternative capital routes may not be sufficient for your capital requirement. And in that construct and within that background, if an private equity investor comes to you who is a good, a reputed investor, and It can fulfill your existing requirement or help you reduce your leverage or debt, give you some impetus to your current fund requirement, and at the same time can be instrumental in setting a benchmark for a good valuation, then it should be definitely positively considered. Once again, I'm telling you, it should be in the overall picture of the scheme of things rather than just as an isolated incident. So,
Okay.
of course, when you bring in private equity holder, it has to be a valuation, it has to be a term sheet, and it has to be your immediate requirement for the fund.
Okay, great. Thank you.
Thank you.
One more question. I don't know if others have questions. Let's give them chance first. I can always interact with you one-on-one also.
Yeah.
Any other questions? No? Okay, so I have one question. Typically, what is a size? Means SME is a good idea, or to wait for grow certain size and then go for the main listing? Do you think that's a better option? Or what is the trade-off? Like if suppose some company is currently operating in a band of, let's say, 200 CR top line with a good healthy bottom line, then whether they should consider SME IPO or they should wait for the main board?
Yeah, that depends upon, once again, first we have to evaluate from the point of view of eligibility criteria.
Okay.
Of course, your top line is good, your profitability is good. What is going to be your paid up capital? If it is going to be more than 25,
LCR.
if it is less than 25 crore, uh, uh, then it is more than 25 crore. Of course, SME IPO is out of questions. If it is less than 10 crore, then main body is out of questions. So either you have to financially restructure it in order to be eligible for that particular route, and then evaluate the options. The second most important thing is, once again, IPO is linked with your vision and growth plan and the capital requirement. So if in the 4 years or 5 years of horizon, the capital generated or raised from the SME IPO is going to be sufficient for your business plan and growth plan. So if that is there, you may consider it, provided you are not qualifying for the main board IPO. Because even from the SME IPO, you can always transit to the main board if you remain listed for 3 years and you fulfill action specific criteria. But if you have a good governance, good financial track record, which fulfill the criteria of Route 6.1, and your capital needs is better fulfilled by the main board, I think looking at overall picture, the cost involved, the compliances and everything, probably you may consider the main board IPO.
Okay. Thank you. Thank you,
So
Bharat.
I will put it link with your eligibility and the capital requirement.
Okay. Because some people I have seen, like, that somebody having opted for SMO IPO, they felt okay, we probably diluted little too early.
Depends. Valuation is, as I mentioned, is a very many dimension.
Right.
The minimum dilution is 25% market float is required. So in any way, either case, it is to be diluted. But the pricing is many dilutions. So even whether in SME IPO or the main board IPO, of course, main board IPO advantage is that you have got a bigger base of investors and probably more stronger ecosystem to work upon.
Okay.
But valuation probably is all depends upon which dimension clicks and how you can project your growth story.
Okay. Thank you.
Thank
Any
you.
other questions from anyone?
Yeah. Paras, good evening.
Good evening.
Yeah. How to handle over subscription or under subscription than your expectation?
Pardon?
When it is over subscribed or under subscribed?
Subscribe or under.
Under subscription is the failure because you have not been able to attract or get the attention of the investor, retail as well as QIBs. So that means your growth story, your equity story, or even your marketing efforts are not good enough for your IPO. So it is a kind of a disaster if you are under subscribing. Oversubscribing should not be only considered as a success benchmark. As I mentioned in one of my slides, that the quality of investors which are coming on board are more important than the kind of oversubscription. Many times the issue get oversubscribed, but the many of the QIBs are either arbitrage fund or hedge fund. What do they see? They see the opportunity window. They subscribe through this IPO, and on the first opportunity, they offload their investment and get out of the earning whatever differences they get. So when they sell in bulk, probably your price goes down in the market. So we need to have a proper book of anchor investor, a long term and establish QIBs. So even if your IPO is subscribed 3 times or 4 times, but with a good quality of investor, I would prefer over 10 times subscription.
Thank you so much. And one more question, if you don't mind.
Yeah, please.
So there are some cases where DRHP is also filed and they have postponed the process, entire process, and they come up with a good, uh, team support with good planning the next time, and they have succeeded. So
Yes.
at what point of time, how to sense that something is going wrong, and if we go with this kind of approach, we'll be definitely undersubscribed and it will be a failure. So how to sense and when to sense that?
This is one of the most important questions or the most important aspect of entire IPO journey. And this is what the subject matter of our third episode, if you have seen, the business diagnostics.
Yeah.
Now, anybody who are thinking about IPO, first look inside, do the introspection. In a way, is my business ready with respect to the financial discipline, with respect to the governance, with respect to compliance, with respect to business process, with respect to manpower or the talent which is there in the company. So before you embark upon your IPO journey, your first step, very first step, starts with the diagnostics of your business in the context of your IPO journey. Not necessarily only IPO, even other regular business can also undergo business diagnostics in order to make it stronger, internally strong, and in order to put it into the growth journey. But when IPO is in mind, the focus, it becomes little more focused. So you identify the gap, then you try to bridge those gaps, give yourself time to bridge those gaps, test, implement your steps which can address those gaps, test those implementation, produce result as a testimony, and then you start your process for IPO. So just based on market sentiment or because your competitor, your fellow company or your friend has gone for the IPO, that doesn't mean that you should also jump for the IPO. Before going for IPO, one has to look internal as well as external, both factor, and then only you should start your IPO journey. We will be discussing more on the episode 3, and I will really suggest you that you attend that episode. It will give lots of lights on your questions.
Sure. Thank you so much.
Thank you.
Thank you. Do we have more questions? Or we wait for 2 more episodes? I think 2 more in 2 subsequent weeks. I think that would make things more clear. And anyway, we are planning one in-person full day workshop post that.
Yeah.
Yeah. So I hope there are no more questions.
Yes, Chairman, we can conclude.
Okay. So thank you all the participants for your active participation and thoughtful questions. On behalf of CII Southern Gujarat, I extend our heartfelt appreciation for Sujata ma'am and Paras bhai for sharing their expertise, practical experience, and valuable insight into the industrial fraternity. Today's session, I think, provided quite a lot of technical and other details for the IPO journey. Now, as discussed, our next session is on business diagnostics. assessing IPO readiness. I think somebody even asked the question very relevant to that. So that is scheduled for 7th of July, same time 3:30 to 4:30 p.m. on the virtual platform, where we'll be discussing on evaluating business preparedness, identifying critical gaps, and also understanding the operational, financial, and governance parameters that companies should strengthen before initiating the IPO process. I'm told that companies, take sometimes as high as couple of years to get there. We also encourage you to mark your calendar for the CII physical conference on IPO readiness and growth capital, which is scheduled for 28th of July. This particular session will bring together industry leaders, investors, market experts, and successful listed companies to share their practical experience and emerging opportunities in the capital market. So we look forward to your continued participation throughout this knowledge series as we collectively explore the complete roadmap for business growth to successful capital market participation. Thank you once again to all of you. We wish you a pleasant evening and look forward to joining you guys back on next Tuesday. Thank you. That is all from my side.
Thank you everybody for participating. We'll see you next week. Have a nice week. Thank you.
Thank you.
Thank you, sir. Thank you, Chairman.
Thank you.
Nice win.
Thank you. Thank you, everyone.
Bye.
Okay.